Good morning, dear student. I am Vikram Singh, Assistant Professor, Department of Commerce from Mewar University. Today, in this class, we understand principle of accounting. Now, these are the content for regarding this topic: accounting principle, overview, then accounting concept. Under accounting concept, we cover business entity concept, going concern concept, money measurement concept, cost concept, dual aspect concept, realization concept, matching concept, and accounting period concept. Now, after that, accounting convention. Under accounting convention, convention of consistency, convention of conservatism, convention of materiality, and convention of full disclosure. Now, let's restart. The overview of accounting principles. The need of accounting principle arise because different parties such as investors, creditors, bank, government or organization are interested to know about the affairs of the business. It means uh, know about the accounting statement of the business. If every business applied its own way of accounting practices, then the final account may not be understandable to all such parties. So, in order to make the final account understandable and to maintain uniformity in accounting system, accounting should be based on certain some standard. These standards are known as accounting principle. The accounting principle are generally we can classify it into two parts: accounting concept and accounting convention. Now, let's start accounting concept. Here, the term concept it is used to denote accounting postulates. It means basic assumptions or condition upon the structure of which the accounting superstructure it is based. So here we have some common accounting concept adopted by various different business concern. Let's start first. Business entity concept. The business entity concept it is a business is treated as a separate entity distinct from its owners. Here we separate business and businessmen. Both are separate. When we start business, first we introduce money in the business. In this concept, the owner of the business and business both are separate. So the owner of the business invest money in business, we showing in our books of account as a capital, and the business this amount will pay in future to businessmen. That is, this capital we show in balance sheet in liability side. It means this concept show as a separate entity concept. Here business and businessmen both are separate. Now the second concept, going concern concept. According to this concept, here we assume that business will exist for a long time. There is no intention to winding up of the business and in immediate future. So according to this concept, we arrange all transaction according to this. According to this concept, we we doing all transaction. We assume here the our business exists for a long term. Okay. Now the next concept, money measurement concept. According to this concept, we record only those transactions which are expressed in monetary form. Here we have two type of transaction, monetary transaction and non-monetary transaction. According to this money measurement concept, we record those transactions involve money part. Okay. Now the next concept, cost concept. According to this cost concept, all transactions are recorded in the books of account at an actual price involved. Suppose we purchase product from a particular city for rupees 5 lakh rupees. Then from a particular city, we bring this product in our business house For regarding this, we pay some expenses. Then we add this pay expenses and invoice price. Suppose invoice price is 5 lakh and freight expenses it is 10,000. Then we add the in cost 5 lakh 10,000. It is our actual price. Now, after that, dual aspect concept. According to this dual aspect concept, here we assume every transaction have two aspects. These two aspects are, one is receiving aspect, another is giving aspect. These two aspects have to be recorded in our books of account. The basis of this principle is that for every debit there is an equal and correspondent is credit. It means here in this concept, dual aspect means one aspect is debit, another aspect is credit. For every transaction, we record in books of account in two times. One aspect, debit aspect, another aspect is credit aspect. Now, after that, realization concept. According to this realization concept, revenue is said to be realized when goods or services are actually sold to customer. It emphasizes the fact that the mere receipt of an order for goods or services cannot be taken for the realization of revenue. It means we receive advance money from customer, then this advance money we don't consider as a realization. Okay, so any advance payment received from customer, here we cannot be considered as a revenue. When actually we sold goods to customer and possession received by customer, then it is assumed the realization money is realized and amount is realized. Now then, matching concept. According to matching concept, here cost of business of a particular period is compared with revenue of that period in order to ascertain net profit. Here this matching concept says that our revenue revenue here match with our all expenses. Suppose our revenue is 100 rupees and expenses 60 rupees. Revenue we mention in credit side of profit and loss account, and expenses we mention in debit side in profit and loss account. Then you match debit and credit. In credit side, revenue is 100 rupees, expenses is 60 rupees. Our differences is it is profit. So according to this, match and find out profit. Now the last concept, accounting period concept. According to this accounting period concept, here we assume the life of the business is divided in a different period. For a period financial statement, for preparation of financial statement. Generally, business concern adopt 12-month period for measuring the income of concern. This time interval is known as the accounting period. Here we also use one term, financial year. The financial year, it is start from 1st April to from next 31st March. This 12 month, it is the accounting period. For this accounting period, we have to calculate our business profit or business loss. Now, after that, accounting convention. Listen carefully. Accounting convention means this is the custom, tradition which guides the accountant while preparing accounting statement. When accountant prepares the accounting statement, these are the basic guidelines for preparing accounting statement. The first one is convention of consistency. This convention of consistency, under this convention follow that the bases follow in several accounting periods should be consistent. It means the method adopted in one accounting period should not be changed in another year. Then only comparison of this result possible. Here, if we adopt any policy, then this policy is applied for a long-term period. This convention of consistency showing this. If one time we adopt any concept, rules, regulation, any policies, these policies apply for a long-term period in a business. Now, after that, convention of conservatism. This is a convention of playing safe which is followed while preparing the financial statement. Under this, the idea of this convention is to consider all the possible losses in future and to ignore all possible profit. Here, for regarding future, if we have any losses, here maybe we assume any losses in future. So for regarding these losses, from today we prepare planning or we maintain some reserve for these losses. And also in future, if we have probable profit, for regarding probable profit, you ignore it because our we business run for a profit. The next one is convention of materiality. Materiality means relevance or importance or significance of any transaction. It is generally accepted in the accounting cycle in circle that the accounting statement and record must several reveals of all material facts. Material facts convention shows that if we have any important item, if we have any important transaction, the value is whatever is value is maybe low or value is maybe high. If importance, then show in books of accounts separately. Suppose we pay audit fees, the amount is very short, amount is very low, amount is very high, it don't matter. But auditing expenses, it is important part showing relevance or importance in books of account. So we have to show in separately in books of account. Now then, convention of full disclosure. According to this accounting convention of full disclosure implied that accounts must be honestly prepared and all material information must be disclosed therein. Here we disclose all information honestly in our books of account. This is all about this topic. Thank you.